Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest strategy update in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Ladies and gentlemen, what if the next crypto bull market isn't driven by hype, but by a complete redesign of the global financial system itself? Because right now, a new Federal Reserve leadership shift, the rise of artificial intelligence, and accelerating crypto regulation are colliding at the exact same moment. And according to some investors, this could be one of the biggest liquidity expansions in modern history. But here's the part nobody's talking about. If AI truly creates a productivity boom powerful enough to suppress inflation, central banks may suddenly gain room to print far more money than markets currently expect. If that happens, assets like XRP, Bitcoin, and tokenized finance may not just rise because of speculation. They could rise because the entire structure of money itself is changing. Right now, crypto investors are becoming incredibly excited again, not just because prices are moving, not just because regulation is shifting, but because something much larger may be happening beneath the surface of the global economy, a structural transition. And at the center of this conversation is XRP. Now, before we get into the price predictions, the hype, and the viral claims flooding around social media, we need to separate short-term noise from long-term structure, because price is reacting, but the system's evolving. And if you understand the difference between those two things, you'll understand why investors are suddenly paying attention to macroeconomics, central bank policy, AI productivity, and liquidity expansion all at the same time. The conversation really accelerated after comments from former Fed Governor Kevin Walsh began circulating again. Kevin Walsh discussed the idea that artificial intelligence could trigger a massive productivity boom across the economy. Not a small one, a structural one capable of lowering the cost of goods, services, labor efficiency, logistics, software creation, and even decision-making itself. Let this sink in. And according to this thesis, the productivity boom could even become disinflationary or deflationary. Now, this is where things get interesting. Because if inflation naturally falls due to technology, the Federal Reserve could theoretically have far more room to lower interest rates and expand liquidity without causing runaway inflation. That idea alone is why so many crypto investors are suddenly becoming bullish again. But to understand whether this narrative actually matters, we first need to understand how liquidity shapes markets in the first place. Because most people think crypto prices move because of technology. That's only partially true. In reality, liquidity has historically been the dominant driver of speculative asset expansion. When money becomes cheaper and abundant, investors move further out on the risk curve. Write this down, ladies and gentlemen. That's massively important. They buy stocks. They buy venture capital. They buy real estate. And eventually they buy crypto. We saw this clearly during the 2020 and 2021 cycle. Near zero interest rates, massive fiscal stimulus, quantitative easing, and trillions of dollars injected into the global economy. The result? Historical explosion across nearly every risk asset on Earth. Bitcoin surged. Altcoins exploded. NFTs went parabolic. And XRP, despite regulatory pressure at the time, still experienced major volatility and inflows. But the real shift came when inflation returned. Suddenly, central banks had to reserve course. Rates rose aggressively, liquidity tightened, and speculative assets suffered. And this is why macroeconomics matters so much now, because crypto is no longer operating in isolation. It's becoming increasingly tied to the broader financial system. And that brings us directly to AI. The argument being made by people like Kevin Walsh is that artificial intelligence could become one of the most deflationary technologies ever introduced into the economy. Think about what AI actually does. It reduces labor costs. It increases efficiency. It accelerates productivity. It automates repetitive work. It compresses time. Tasks that once took 10 employees may eventually require one. Tasks that once took days could take minutes. And historically, productivity revolutions have dramatically reshaped economic systems. One real historical example comes from the Industrial Revolution in the 18th and 19th century Britain. Industrial Revolution, before mechanized industry, production was slow, localized, and labor-intensive. Then factories, steam engines, mechanized textiles, and industrial logistics changed everything. Productivity surged, output exploded, costs fell, and entire financial systems evolved around this new productivity capacity. And here's the key detail most people miss. Technological revolutions often create enormous wealth expansion long before society fully understands the implications. The internet era worked similarly. In the 1990s, many investors underestimated how profoundly the internet would reshape commerce, communications, advertising, banking, and global business. Today, AI may represent a similar transition, not identical, but structurally comparable. And this is where the crypto conversation becomes fascinating. Because if AI suppresses inflationary pressure while productivity accelerates, central banks may gain flexibility they haven't had in years, potentially lower rates, potentially easier financial conditions, potentially more liquidity. And liquidity changes everything. Now, does that automatically mean XRP goes to 1,000? No. And this is where we need to stay grounded. A lot of viral crypto narratives confuse possibility with inevitability. Could digital assets benefit from increased liquidity over a decade-long horizon? Absolutely. Could tokenization, institutional adoption, and global settlement systems expand significantly? Potentially, yes. But massive price targets require equally massive structural adoption. That distinction matters because there's a huge difference between speculative enthusiasm and real systematic integration. And XRP's long-term thesis has already evolved around infrastructure. And XRP is often discussed in the context of cross-border payments, liquidity rails, and tokenized financial systems. Supporters argue that if financial institutions increasingly tokenize assets and move value globally in real time, networks capable of fast settlement could become more relevant. Critics argue adoption remains uncertain, competition is intense, and regulatory clarity still matters enormously. Both perspectives are important. Now, this is what most people miss. Even if AI creates deflationary pressure, central banks still need stable economic growth. Deflation sounds good on the surface, lower prices, cheaper goods, more purchasing power. But sustained deflation can become dangerously economical because consumers begin delaying purchases, businesses slow investment, debt burdens become hard to manage, and economic activity can contract. This creates what economists sometimes call a deflationary spiral, and central banks historically try very hard to avoid it, which means if productivity-driven deflation accelerates, policymakers may attempt to offset it with easier monetary conditions. That could mean lower rates, potentially renewed liquidity programs, and possibly broader monetary expansion over time. Now let's connect this directly to crypto markets. When liquidity expands, speculative narratives often accelerate faster than fundamentals. We've seen this repeatedly throughout financial history. One historical example was the Roaring Twenties in the United States. Roaring Twenties, rapid technology innovation, expanding credit availability, industrial productivity growth, and financial speculation all combined into a massive asset boom. Radio technology exploded. Automobiles transformed the society. Consumer spending accelerated and financial markets became euphoric. Now, obviously, history never repeats perfectly, but the analogy is important. Today, AI is being discussed with similar transformational enthusiasm, and crypto sits directly inside the speculative technology narrative, especially products connected to infrastructure, tokenization, payments, and digital finance. But here's where things become even more important. Regulation. Because regardless of how powerful AI becomes, crypto adoption still depends heavily on regulatory frameworks. That's why investors are watching legislation like the Clarity Act and broader digital asset policy. Developments slow closely. Institutions generally do not deploy serious capital into uncertain regulatory environments. They need compliance, legal definition, operational standards, custody clarity, accounting treatment, risk frameworks. And once those frameworks begin stabilizing, institutional participation can increase substantially. That does not guarantee price rise immediately, but structurally it matters because short-term noise moves markets temporarily. Long-term structure changes industry permanently. This is exactly why tokenization has become such a major conversion. Tokenization essentially means representing real-world assets digitally on blockchain infrastructure, stocks, bonds, real estate, treasuries, commodities, settlement systems, collateral systems. Many major financial institutions are already exploring this area, not necessarily because they love crypto culture, but because programmable settlement systems could reduce friction, costs, and settlement times across global finance. That's the real institutional conversation happening beneath the headlines, not memes, infrastructure. And if blockchain infrastructure increasingly integrates into traditional finance over the next decade, assets associated with those systems may gain relevance. Again, may, not guaranteed. And this distinction matters because crypto markets often price in future expectations far earlier than actual adoption arrives. That's why volatility remains so extreme. Now let's zoom out even further, because there's another layer to this story. Debt. Modern economies are carrying enormous sovereign debt burdens. Governments around the world have accumulated trillions in liabilities. Historically, there are only a few ways heavily indebted systems reduce debt burdens. Higher growth, inflation, currency debasement, financial repression, or some combination of all four. This creates a fascinating macro backdrop for scarce digital assets because many crypto investors increasingly view assets like Bitcoin as monetary alternatives during periods of aggressive monetary expansion. Write that down, ladies and gentlemen. Let that sink in. It's very important. Bitcoin is often described as digital scarcity. XRP supporters frame that asset differently, more around utility and settlement infrastructure. But both narratives intersect around one key idea. Future architecture of money may evolve significantly over the coming decades. Now, here's a second historical analogy. The current transition resembles the early railroad expansion era in the 19th century. At the time, railroads weren't just transportation systems. They became entirely new financial infrastructure layers. Capital markets evolved around them. Supply chains transformed. Cities expanded. Entire industries reorganized around faster movement of goods and information. Changed the world. Today, some analysts believe blockchain networks may become a similar infrastructure layer for value transfer itself. Not identical to railroads, but structurally similar in terms of systematic transformation potential. And if that thesis proves partially correct, then today's volatility could eventually look like early-stage infrastructure development rather than isolated speculation. But the real shift came when AI entered the equation, because now we're not just talking about blockchain anymore. We're talking about a convergence of technologies. AI, automation, tokenization, digital payments, real-time settlement, machine-driven finance. This is where some investors begin to envision dramatically larger economic systems than the ones we're operating under today. And if productivity generally accelerates at scale, global GDP growth itself could expand, which means more capital formation, more financial activity, more investment flows, and potentially larger digital asset markets. But again, there are major risks. AI could disrupt labor markets faster than economies adapt. Regulation could slow adoption. Governments may resist. Decentralized financial systems. Competition among blockchain networks remains intense. And speculative excess can create massive bubbles long before real adoption materializes. We saw this during the dot-com era. Many internet companies failed completely despite the internet itself transforming the world. That distinction is critical. A powerful technological trend does not guarantee every related asset succeeds. Now, this is what most people miss. The biggest gains in financial history often come not from predicting a single price target, but from identifying structural trends early and remaining patient enough through the chaos and the volatility not to get caught up like sushi. That's why Warren Buffett's famous phrase about time in the market continues resonating with investors decades later. Because compounding matters, patient matters, surviving volatility matters. Crypto markets especially remain incredibly emotional. People become euphoric during rallies and fearful during downturns. But institutional adoption, regulatory integration, and infrastructure evolution are generally multi-year processes, not overnight events, which brings us back to XRP, the anointed one specifically. A lot of the excitement around XRP comes from the idea that if tokenized financial systems expand globally, assets capable of facilitating liquidity and settlement could benefit structurally. Supporters often point to cross-border settlement inefficiencies in traditional banking systems. Slow transfers, high costs, fragmented liquidity, legal infrastructure. And they argue blockchain-based settlement systems could improve these areas over time. Skeptics counter this. Traditional financial institutions may build private systems instead of relying on public crypto networks. Again, both arguments deserve consideration because the future likely won't be fully decentralized or fully centralized. It may become a hybrid system, and hybrid systems often evolve gradually. Now let's talk about the AI productivity thesis more deeply, because this is the centerpiece of the entire narrative. If AI dramatically increases productivity, companies would produce more output with fewer inputs. That means margins improve, costs decline, and economic efficiency rises. Historically, productivity gains have been one of the strongest long-term drivers of economic expansion. But productivity booms can also create transitional instability. Job shifts, industries reorganize, skills become obsolete, capital reallocates rapidly, and financial markets attempt to price all of this in real time. That creates enormous volatility, which is exactly why speculative assets often move violently during technological transitions. Now imagine a world where AI tools become deeply embedded into nearly every business process. Customer service, programming, research, manufacturing, legal review, medical diagnostics, financing modeling, logistics optimization, marketing, supply chain management. Productivity implications become enormous. And if inflation remains relatively contained during that process, central banks may eventually become more accommodative than markets currently expect. That's the macro thesis driving much of the current optimism, not just for crypto, for equities as well, especially technological focused assets. And if liquidity conditions improve while regulation simultaneously becomes clearer, crypto could experience another major institutional expansion phase. But here's the major caveat. Speculative narratives often overshoot reality. Every cycle creates exaggerated expectations. During the internet boom, people believed every website would become a $1 trillion company. That obviously didn't happen during the crypto bull market. Many projects achieved valuations disconnected from actual adoption. That's also correct. Some investors need to distinguish between narrative momentum and sustainable infrastructure growth. That's the difference between speculation and long-term investing. Now let's discuss the psychology of price predictions, because this is where many viewers get trapped emotionally. When people hear targets like $100 XRP or $1,000 XRP, the brain naturally focuses on the upside potential. But mathematically, massive price appreciation requires massive market capitalization expansion, which means either huge liquidity inflows, massive adoption, or both. Could those things happen gradually over a decade or longer? Possibly, especially if global financial systems increasingly digitize. But the timelines matter enormously, and markets rarely move in straight lines. There will likely be volatility, corrections, policy shifts, regulatory battles, technological competition, and macroeconomic shocks along the way. That's simply how emerging technologies evolve, but the long-term structural conversation remains extremely important. Because whether people realize it or not, the world is entering a new monetary and technological era simultaneously. AI is reshaping productivity. Digital assets are reshaping value transfer. Governments are exploring digital currencies. Financial institutions are exploring tokenization. And younger generations increasingly operate inside digital native financial ecosystems. These trends are real. The debate is not whether change is happening. The debate is how large a change becomes and who benefits from it. Now, this is where things become incredibly interesting for XRP investors specifically, because XRP has always occupied a strange position within crypto. It's not fully treated like a traditional decentralized asset narrative, but it's also deeply connected to conversations around institutional finance. That hybrid positioning makes it uniquely controversial. Some investors see enormous utility potential. Others remain skeptical. But regardless of where some people stand, and someone stands, it's impossible to deny that the broader financial conversation is shifting towards faster settlement systems, tokenization, and digital infrastructure. That structural direction matters, even if individual outcomes remain uncertain. And ultimately, that's the biggest takeaway from this entire discussion. The story here is not simple. Will XRP hit a certain number? The biggest story is this: what happens when artificial intelligence, monetary policy, and digital finance all collide at the same time? Because that convergence could define the next decade of global markets. Short-term noise will continue, price will fluctuate, headlines will create emotional reactions. But underneath all of that, the financial system itself may be evolving. And some investors who understand structural transitions early often position themselves very differently than investors focus only on daily volatility. That doesn't mean blind optimism. It doesn't mean ignoring risks. And it certainly doesn't mean every crypto project succeeds. But it does mean understanding that technological revolution historically reshaped financial systems in ways that initially seem impossible. The internet did, industrialization did, mobile computing did, and now markets are asking whether AI and blockchain together could become the next major transformation. That happens, liquidity dynamics may change, productivity may accelerate, digital infrastructure may expand, and crypto markets can mature far beyond where they are today. Whether XRP becomes one of the major beneficiaries remains uncertain, but the macro forces driving this conversation are very real. And that's why investors are paying such close attention right now, because price is reacting, but the system's evolving. If you enjoyed this breakdown, make sure you subscribe, hit the like button, and join the Wolfpack. And let me know in the comments, do you think the crypto era is entering its infrastructure era? Or do you think that this is just more noise? I want to hear your thoughts. Or are the markets still trapped in speculation mode? Because we're tracking the macro shifts, institutional signals, and the structural changes most people overlook. As always, do your own research. Never invest based solely on a YouTube video. And remember, short-term noise, long-term structure. I'll see you in the next one. Well, ladies and gentlemen, I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly. I want to welcome all the new members of the membership channel. I want to go over something right now that most people aren't paying attention to, because everybody's distracted by AI stocks, everybody's distracted by Bitcoin, everybody's distracted by Nvidia and earnings. Meanwhile, one of the most important markets on planet Earth just quietly sent a message so loud that almost nobody noticed it. Copper just blew through 14,000 per metric ton. That's right, baby, constant copper. And if you don't understand why that matters, you don't understand what's about to happen to infrastructure, manufacturing, EVs, data centers, energy grids, military production, frankly, the next phase of global inflation. Because this is not just a commodity story anymore, ladies and gentlemen. This is a supply chain factory story. This is a supply chain fracture story. This is a geopolitical story. And most importantly, this is a smart money already had move story, ladies and gentlemen. See, retail investors, and again, I'm not used to talking to retail people. I don't work for retail people. The people that are in any capacity are not retail people. They're far from that. But retail investors look at charts. That's why they get cut up like sushi too many times. Professionals look at inventory flows. Retail traders look at headlines. Institutions look at treatment charges, refining spreads, scrap retention rates, sulfur bottlenecks, and physical deficits. I've gone over these in the second parts of our videos always, and I guarantee that most people just tuned right out, that it was too boring. It was like watching paint dry on the wall. That's why retail gets cut up like sushi, because it's the boring things that are the most lucrative. It is. That's why there are more, ladies and gentlemen. And right now, every single one of those indicators is flashing red at the same time. UBS just reiterated a projected 520,000 metric ton copper deficit for 2026. That's not 52,000. That's 520,000. That is a massive structural imbalance between supply and demand. And the crazy part, most people still think copper is just industrial metal stuff. I can't believe this. No, wrong answer. Do not pass go and collect $200. Copper is now the bloodstream of modern civilization. Write that down. Let me explain what's actually happening. The world decided it wants AI infrastructure, EV adoption, renewable energy, electrification, grid modernization, hyperscale data centers. Cool, right? There's just one problem. All those things consume absurd amounts of copper. A single EV uses roughly 3 to 4 times more copper than a combustion engine vehicle. Data centers, massive copper intensity. Grid expansion, massive copper intensity. Solar, wind, transmission lines, industrial automation. Copper, 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 copper. And while demand is exploding, supply is basically falling apart in slow motion. This is where the story gets insane, ladies and gentlemen. Chile, the world's largest copper producer, has already seen production decline roughly 6% year over year. China is facing severe shortages in copper concentrate, scrap supply, sulfur inputs, treatment and refining charges, which are one of the most important hidden indicators in the metals market. The collapse from around 25 per ton in 2025 to effectively zero in 2026. Do you realize how scary this is, ladies and gentlemen? Do you have any understanding what this really means? Let me know in the questions and comments, because maybe I'll make some content on that. Spot charges actually went negative, ladies and gentlemen. Do you understand how abnormal that is? It's crazy. That's like seeing Bigfoot and telling somebody. That means smelters are effectively fighting over material so aggressively that the economy's completely broke. That is not a normal market. This is what panic inside industrial supply chains look like. Here's the detail nobody's talking about, at least in TV, mainstream. This is what family offices and people that are tennis in any capacity are talking about, and the broader players are talking about. Japan, which accounts for roughly 7% of global scrap exports, write this down, is now increasingly keeping scrap domestically instead of exporting it. Why? Because everybody sees what's coming. Countries are beginning to behave like copper scarcity is strategic, because it is. You cannot build energy independence without copper. You cannot build AI infrastructure without copper. You cannot build military resilience without copper. This is no longer just economics. This is resource security. And the market still hasn't fully priced the reality in. But this is where this gets even more crazier. And I was having a discussion about this earlier with a family office, and it gets more dangerous. While copper is screaming shortage, palladium is doing the exact opposite, and that divergence tells you everything about where the global economy is headed, okay? According to UBS, they expect palladium to move into a surplus this year after 14 straight years of deficits. That's a huge regime change, ladies and gentlemen. Last year, the market was undersupplied by 416,000 ounces. This year, expected surplus of around 200,000 ounces. Write that down. And the reason matters more than the numbers, because palladium is heavily tied to internal combustion engine through autoclasts. Translation: the decline in combustion vehicle demand is beginning to show up physically inside commodity flows. Again, That is an enormous macro signal. Copper is exploding because the world is electrifying. Palladium is weakening because the old industrial model is slowly dying. That's the transition. That's the trade. If you take anything from what I'm saying right now, rewind this, write that down. That's the entire global economic rotation happening here in real time. This is why surface level financial content is useless right now. People argue over candlestick patterns. Why physical inventories are collapsing is like debating deck chair placement on the Titanic. It is. I don't like this one. The candle's going red. It went down since your last video. Blah, 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 blah. You need to understand flows, ladies and gentlemen. You need to understand inventories. You need to understand how commodities deficits actually work. Because once shortages become visible to the public, the move is already over. The deliciousness is over. That Gucci clarity, that Gucci conviction, all that recce, all that planning would have been bearing the fruit, and the trade is over. Smart capital watches the invisible phase. Smart capital also is able to retain certain types of talent to do certain things for them, while most people just complain over charts. Right now, the invisible phase is screaming. Look at the inventory behavior, ladies and gentlemen. Shanghai copper inventories have fallen by roughly 178,500 metric tons since the end of March. And at the same time, COMEX inventories rose over 38,000 metric tons. LME inventories rose more than 35,000 metric tons. Why does that matter? Because inventory location matters. The market repositioning material in anticipation of tariffs, trade, fragmentation, and regional supply stress. This is exactly what sophisticated commodities desk monitor. Not Twitter sentiment, not YouTube thumbnails, physical flow dynamics. This is what people really don't want to hear. According to UBS, they're forecasting 14,000 copper by September 26, 14,500 by December, 15,000 by March 2027, 15,500 by June 2027. And those are not mean predictions, ladies and gentlemen. Those are institutional forecasts based on refining economics, supply disruptions, inventory drawdowns, infrastructure demand, structural underinvestment. This is what happens when the physical economy collides with policy fantasy. Governments spent years announcing electrification targets without securing enough raw materials to actually build the future they promised, and now the build is arriving. See, the reason most people miss these shifts is because they wait for consensus. But by the time consensus arrives, institutions already positioned, supply chains already repriced, margins already compressed, inflation already transmitted downstream. This is why understanding macro commodities is such an unfair advantage. They tell you what the real economy is doing before economists admit it. Copper is not just a metal, ladies and gentlemen. Copper is a lie detector for the industrial civilization. And right now, it's telling us demand is structurally stronger than the supply system can handle. This is also why serious analysts requires more than headlines. You have to track warehouse flows, speculative positioning, refining spreads, treatment charges, import data, smelter behavior, ETF positioning, trade policy, scrap retention, production disruptions. That's how professionals build conviction before price moves become obvious. Most people only see the chart after the move. Institutional analysis sees the pressure building underneath the chart months in advance. And that difference changes everything, ladies and gentlemen. Because we're entering a world where commodity scarcity becomes geopolitical power, energy security, grid security, manufacturing security, and AI infrastructure dominance. All of it comes back to physical resources. And the scary part, the world spent the last decade pretending software alone runs civilization. It doesn't. Oh, God. Civilization still runs on mined materials. And when those materials tighten, everything changes. So when you see a copper making new all-time highs and palladium rolls overnight, you're not just watching two commodities move. You're watching the old economy hand the baton to the new one. You're watching electrification collide with resource scarcity. You're watching the next inflation regime quietly form underneath the surface. And most people won't notice until the consequence hits consumers' prices, industrial margins, and financial markets all at once. By then, the smart money would have been gone. Ladies and gentlemen, if you want to learn how to take advantage of all of this, do come and join the Crypto Public Desk Monthly. One tip from the pits can pay for your entire year subscription. Join over 560 active traders and investors who've decided to pay attention to the macro data, and they want to become a financial mercenary, and they want to make a difference in their lives. But this is what we're paying attention to. Copper markets are entering a severe structural deficit. UBS projects a 520,000 metric ton copper deficit in 2026. Copper demand is being driven by EVs, AI infrastructure, renewable energy, and grid modernization. Chilean production weakness and Chinese supply bottlenecks are tightening global inventories. Treatment and refining charges collapsing towards zero. signals severe raw material scarcity. Palladium is shifting from deficit to surplus due to declining internal combustion energy demand. Commodity flows reveal macroeconomic shift before mainstream financial media notices them. Physical inventory of dynamics matter more than retail sentiment during structural transitions. What we're paying attention to, and anyone has any capacity, Shanghai copper inventory drawdowns, LME and COMEX warehouse positioning, China copper import data, U.S. copper tariff derivatives, scrap export restriction retention behavior, smelter treatment refining charges, EV adoption rates globally, data center grid infrastructure expansion, ETF positioning palladium and industrial metals, Chile and Peru mining disruptions. Why this is important, ladies and gentlemen? Because commodities are upstream of the entire economy. When copper tightens, infrastructure costs rise, energy transitions costs rise, manufacturing margins compress, inflation pressure increases, geopolitical competition intensifies. Copper is becoming a strategic asset tied directly to AI infrastructure, energy systems, electrification, industrial sovereignty, and the investors, operators, and analysts who understand these shifts early gain a massive informational advantage before the broader market catches up. Ladies and gentlemen, if you want to understand how to prosper from everything I just said, again, come and join the Crypto Republic Desk monthly inside of our Patreon. One tip from the pits pays for your entire year subscription. They can pay for your entire year subscription. Learn how to take advantage of all this because this is where we're going. I've been taking things out of the ground for 20 years. We have our own refineries. And let me tell you something. The world's changing. I love you all. Don't get caught up like sushi. This content's for informational and entertainment purposes only. It should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions, always. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves it'll never happen again. Or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right until the moment they're not. And this is one of those moments. Do not blink because the world is distracting you with noise. While XRP continues developing behind the scenes and building momentum in the broad digital asset landscape. Stay sharp, stay informed, accumulate knowledge. You move now, be remembered. It's not the end of the story. This is just the beginning. This opened your eyes, smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notification. The most important is subscribe to the Crypto Republic. We break down the major global banking trends shaping assets today, giving you context, clarity, research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the public. I love you all. Don't get caught up like sushi with the remora. See you in the front lines.